Scottish Mortgage is a very large investment trust and it's been extremely successful recently with very strong returns in 2017. So there's been a lot of interest in the fund. Now the fact that it's an investment trust is both a benefit and also a drawback. So let's find out about that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Scottish Mortgage is incredibly successful and also a very large fund. Its total assets are over £7.6 billion as of October 2018. And in fact it's so large that it's now part of the FTSE 100, which is the 100 largest companies that trade on the London Stock Exchange, and it's been there since February 2017. The primary driver of success and failure for an active fund is who runs the fund. And for Scottish Mortgage, it's James Anderson and Tom Slater. Their skill sets complement one another very nicely. Whereas James Anderson has an arts background because he studied history at Oxford and he then went on to study for an MA in International Affairs, Tom Slater is much more numerical and he has an undergraduate degree in computer science with mathematics from Edinburgh University. James Anderson has been co-manager of this fund since 2000, so that's almost 2 decades of running the fund. And as a result, the fund has a great deal of continuity. Tom Slater has been deputy manager of the fund since 2010 and became joint manager with Anderson in 2015. And he's also head of the US equities team. And both are partners in Baillie Gifford, which runs Scottish Mortgage and many other funds. James Anderson founded a group called the Long-Term Global Growth Strategy Team in 2003. So it's not just these two people who run the fund, they can draw on the resources of the Long-Term Global Growth Team. That's particularly important because they have to monitor whether stocks are still adhering to the principles by which the fund is run and whether their investment thesis still applies to that company. Plus they have to continually look for new opportunities as market conditions change and as companies' fates change. Scottish Mortgage is an investment trust, and in order to understand the fund, it's very important to understand what an investment trust is. An investment trust is a company that buys the shares of other companies, and because it's a company, it has a board. These are the 5 board members for Scottish Mortgage, and it's their job to ensure that the fund's being run for the benefit of shareholders, who are the investors in the investment trust. Now this board is really outstanding in terms of the skills they bring to the table for the fund. The chair, who's Fiona McBain, used to be the CEO of Scottish Friendly Assurance, which has over 1 million customers, and she's also a qualified chartered accountant. Paolo Subacci is an economist, an author, an expert on China, but she also has a great deal of expertise in international affairs, which is very important given the very large China exposure of the fund and the fact that it's global. Patrick Maxwell brings in biotechnology expertise. He's Regius Professor of Physics, which is the archaic word for medicine, and also the head of School of Clinical Medicine at Cambridge. John Kay is Investment Officer at St John's College, Oxford. He's also a world-famous economist and academic. And Justin Dowley brings investment banking experience to the team. He used to be head of investment banking at Merrill Lynch for Europe, and, like Fiona McBain, he's qualified as a chartered accountant. The fact that the fund is an investment trust is just one type of wrapper for the fund. You could take the same assets and wrap them up as an exchange-traded fund or as an open-ended investment company, but that would fundamentally change the nature of the fund. The primary difference is that if money flows into the fund, an exchange-traded fund or an open-ended investment company will automatically generate more shares or more units, whereas an investment trust doesn't grow. That means that the investment trust doesn't have to buy more shares whenever it has an inflow of funds. Similarly, if people sell the fund, an exchange-traded fund or an open-ended investment company reduces the number of shares or units and they have to sell their assets. And that means they don't have control over the timing of purchases and sales. These are driven very much by inflows and outflows from the fund, whereas an investment trust keeps control of the timing of its trades. And that, in theory, means that they can time their trades better, and that may lead to better returns, because they won't be a forced seller in falling markets or a forced buyer in rising markets. One consequence of the fixed number of shares in an investment trust, such as Scottish Mortgage, is that the net asset value, which is the value of the stocks and shares that it owns, may deviate quite substantially from the price of the fund. Here's the net asset value of the fund since 2006 in green versus the price of the fund in black. When the fund's performing poorly, as happened in 2008 and 2009, the price of the fund lags behind the net asset value, and we'd say that the fund is trading at a discount. Investment trust experts would say that this is a buying opportunity. You can buy the assets at less than their current net asset value when it's trading at a discount. But during periods of very strong performance, the price goes above the net asset value and the fund is trading at a premium. And that's been the case recently, from 2016 to the end of 2018. And because it's a company, Scottish Mortgage has to publish an annual report. This contains very detailed accounts, including the balance sheet, cash flow, and income statement, plus details of exactly how the fund is being run and how well it's performed. Independent auditors then look at the accounts and ensure that they're correct, and that auditor's report is a prerequisite if you trade on the London Stock Exchange. And between the annual statements, you also get an interim financial report to keep you up to date. As a shareholder in the company, you get to vote in the annual general meeting. This is held every summer in Edinburgh, and at that meeting you can vote on the decisions of how the fund is run, because you're a part owner of the company. And the report is extremely well written and definitely worth a look if you really want to get to grips with the details of how the fund is run. Personally, I really enjoyed reading it. It's very clear, and whether you agree with it or not, it lays out their investment thesis in language that anyone can understand. Another consequence of being a company is that Scottish Mortgage can borrow money. This increases the size of the fund and amplifies the gains and the losses of the fund. And the gearing as of 2018 was about 10%, which boosted the risk of the fund, but during market rallies also boosted the return. And the annual report contains details of the bonds that were issued in order to boost the capital of the fund. You can see the interest that they're paying on the bonds is around 3%. And as the fund grows or shrinks, they may increase or decrease the borrowings to match over time in order to ensure the gearing stays roughly constant. Now let's look at the details of the investment approach. The fund is active, which means that it's trying to beat an index rather than track it. It's low cost, which means you don't have to pay much in fees every year, which is great. It's a high conviction fund, which means they take very large positions once they find a company that they like. The fund's focus is for the long term. So if you're looking for a quick short-term profit, this is not the fund for you. And the benchmark for the fund is a FTSE All-World Index in sterling terms, which means that it's a global equity fund. They can buy shares from anywhere in the world. Now, the last thing that you want for an active fund is for it to hug its benchmark, because what you're paying the fund to do is to deviate from the benchmark and to beat the benchmark. The Financial Conduct Authority in the UK is clamping down on these closet trackers which hug their benchmark. Because remember, an active fund will charge you more than a passive fund. So if companies are marketing their fund as active, they shouldn't be passive trackers. They should deviate from the benchmark. And the FCA has actually censured some companies because of the fact they were hugging the benchmark. That's why it pays to look at a measure called active share, which is 100% minus the overlap between the portfolio and the benchmark. Diagrammatically, I've shown the portfolio in blue and the benchmark in yellow, and the overlap between the two is shown in green. If the portfolio and the benchmark are identical, then the overlap would be 100%, and the active share would be 0. If the portfolio and the benchmark have no overlap at all, then that would give you the maximum active share. So if the active share is 0, the portfolio would be identical to the benchmark, and that's equivalent to benchmark hugging. Whereas if the active share is 100%, then there's no overlap between the portfolio and the benchmark at all. And in October 2018, Scottish Mortgage had an active share of 94%, so it could certainly not be accused of being a benchmark hugger. Far from it, it has very, very high active share. For example, in September 2018, 10% of the portfolio was in Amazon, which means they have a huge conviction that Amazon is a very good company. As a result of their high conviction investment approach, their largest 30 holdings make up 4/5 of their portfolio, and they only hold 79 shares in the fund. What these lists show is how long they've held each of their stocks. The panel on the left shows stocks that they've held for more than 5 years, and the blue circles with a 10 inside show companies which they've held for a decade or more. So for example, Amazon has been held for over a decade. So have the Chinese companies Tencent and Baidu, and the parent company of Google, Alphabet. And 61% of the portfolio has been held for more than 5 years. So once they identify a company which they like, they tend to hold on to it for a very long period of time. And that means they pay very little in trading costs. There's not much turnover in the portfolio. Also notice that some of the stocks are marked with a U. That means it's an unlisted security, or in other words, you can't buy it on a stock exchange. Now, because they're small companies, they have the potential to grow very rapidly, and a great deal of the performance of the fund comes from these unlisted companies which become listed later on as they become very successful. That was certainly the case for Alibaba, but also for Dropbox and Spotify. However, some of these companies have been a disappointment. For example, the online furniture sales company Home24 and the recipe box company HelloFresh. But obviously not all of the investments will be successful. In the chairman's statement in 2018, Fiona McBain identified 6 factors that would contribute to the success of the fund. Number 1 is the continual rise and development of China. And other themes include big data, industrialization of biology, electric and self-driving cars, and energy generation. Some global funds operate on a top-down basis. In other words, they look for macroeconomic trends and then they decide on the stocks which fit in with those trends. Whereas other funds look at the minutiae of individual companies and buy the companies that meet specific criteria. However, Anderson says that the two meet and meld together, top-down and bottom-up, because what they look for are long-lasting economic trends, which are likely to pan out, they're high probability, but also of high importance. And the third point is that they're going to last for decades. And he thinks it's irrelevant to try and guess what the Federal Reserve's going to do to interest rates in the next quarter, which is the approach of some top-down funds. Tom Slater is also very dismissive of the idea that Scottish Mortgage is a technology fund. These are also sometimes called FANG funds. Slater then clarifies that by saying, where do these trends take us? Many people know about Moore's Law, but the question is, what investable trend does Moore's Law create? One consequence is that cars can drive themselves, because they can process radar data and visual data very rapidly and react quickly enough to drive safely. Or in healthcare, we've seen the development of high-throughput sequencing, where you can work out the sequence of an entire genome for an organism in a matter of days. And now that the technology exists, prices are coming down, and it's likely that that will transform medicine. And Slater goes on to say that it's not just a matter of identifying a trend, they look for the companies which make those trends happen. So the therapeutic healthcare companies which the funds bought are the ones which are driving that technological change based on improvements in the understanding of the genomic basis of disease. One example of companies which the fund holds is Illumina, which sells machines which can do whole genome sequencing, and it does so very rapidly, so that not only can you sequence an individual's genome, you can do it for an entire population, which lets you build correlations between the genome and disease. And this could transform diagnosis of disease by rapidly sequencing someone's genome. And it can also be used for agricultural breeding programs. And when it comes to autonomous electric cars, the company we've all heard of, which is driving that trend, is Tesla. And Scottish Mortgage is one of Tesla's large investors. It's also a big investor in companies like Alibaba, which has completely transformed the landscape for business-to-business transactions in China and elsewhere. Now, you should always consider the cost of the fund. So how much does Scottish Mortgage cost? The ongoing charge is 0.37% per year as of 2018. That means an investment of £10,000 would cost you an annual fee of £37. For an active fund, that's very competitive. For example, Lindsell Train charges 0.74% per year. And even if you hold it on Hargreaves Lansdown, it costs 0.54% per year. And Terry Smith's Fundsmith Global Equity Fund is 0.95% per year. And now that the fund has grown so large, in April 2017, the company introduced a tiered annual management charge, which applies 0.3% per year for the first 4 billion of assets under management, but only 0.25% above that level, which means that if the fund grows much more, the fee is going to fall, which is great for its investors. The primary reason for the popularity of the fund is its performance. In the top bar here, you can see the annual performance since 2007, and you can compare that with the FTSE All-World Sterling Index, which is its benchmark. And in the bottom two panels, I've also shown Fundsmith Equity and Lindsell Train, which are two other very popular and very successful global equity funds here in the UK. Scottish Mortgage hasn't always been a great success. In 2008, it made a very large loss of 45%, which is more than twice the loss of its benchmark, the FTSE All World Sterling Index. That's partly because of the choice of stocks it favours, but also partly because of the leverage which it employs, which amplifies losses as well as gains. But on the upside, during years in which the benchmark rose, Scottish Mortgage tends to rise much more. In 2013, the benchmark rose by 18% and Scottish Mortgage rose by 30%. And it had a particularly good year in 2017, rising by 40%, which is 4 times its benchmark return and considerably higher than Fundsmith Equity and Lindsell Train, which only managed about 22 to 25%. So what would have happened if you'd invested £100 in 2011? The purple line shows what would have happened to your £100 if you'd invested in a passive global tracker called iShares MSCI Global. Scottish Mortgage sometimes lagged below iShares Global. In fact, it did so for much of the period before 2016, but then it really started to rise rapidly, far above MSCI Global, as its bets in the technology sector in particular started to pay off. Lindsell Train has always been above MSCI Global, but Scottish Mortgage caught up with it around the end of 2017. But the winner by a fairly large margin is Fundsmith Global Equity, which over this period generated the best return of all. Those are the historic returns. Now let's consider the risks you're taking when you buy the fund. One risk is concentration. Half of the money of the fund is invested in North America, and about a fifth is invested in China, which is an emerging market country and therefore quite risky. About a quarter of the fund is invested in Europe. So while there is some geographic diversification, there's a very concentrated risk in China, which is more risky than developed markets. And despite saying it's not a technology fund, about a quarter of the fund is invested in technology stocks, and a third is in consumer services, and a fifth in healthcare. So we also see very high sector concentration. If any of the sectors with very high weighting underperforms, it would have a serious effect on the fund. On the x-axis here, I've plotted the daily return of its benchmark, the FTSE All World Index. And on the y-axis, we've got the daily return of Scottish Mortgage. If the two moved together one for one, they'd be clustered around the dashed black line. Instead, they're clustered around the red line, which is 34% steeper than a one-for-one move. The beta of the stock is about 34%, which means that during rallies, Scottish Mortgage will rally by about a third more than the market. But unfortunately, during sell-offs, it'll also fall by a third more than the market. And this high beta is why it's riskier than buying the benchmark. The higher risk is also reflected if we look at the volatility of the fund, which is around 20%. That's higher than MSCI World or its benchmark, and considerably higher than Lindsell Train and Fundsmith. If we plot the risk and return since 2011 so that risk is on the x-axis and return is on the y-axis, we can see that Scottish Mortgage is a bit problematic. That's because Fundsmith Equity has a lower risk because it's further to the left of the graph, but it also has a higher return than Scottish Mortgage over this period. Lindsell Train 2 has a higher return and a much lower risk, which begs the question, is it worth taking the extra risk of Scottish Mortgage given that that extra risk hasn't generated proportionately higher returns, or at least not over this period? Scottish Mortgage is also heavily exposed to global trade. An environment which threatens global trade is going to be toxic for Scottish Mortgage. So President Trump's policies and his trade war could turn out to be problematic unless they're resolved. Because remember, China and the US are two of the biggest allocations for the fund. And although Anderson is dismissive about using Fed policy to decide allocation, it could be very important for the fund. This is the federal funds rate, which is set by the US Central Bank, the Federal Reserve, since 1955. The grey bars show US recessions, and generally, when the Fed is raising interest rates, a recession isn't too far behind. And that's precisely what's happening at the moment. The Federal Reserve is raising interest rates, and we're coming up to almost a decade without a recession, which is very unusual. And growth stocks are obviously very sensitive to global growth, and so would fare very badly during a recession, as we saw in 2008 and 2009. So this might not be an ideal environment for buying into the Scottish Mortgage Fund. I can't resist putting a quote from John Bogle, the founder of Vanguard, and this is something he said in 2005, and it's a salutary tale about Bill Miller. What Bogle's saying is that in 1945, most funds were managed by a committee, but then in the 60s, we started to get a star culture, which favoured freewheeling individual talent. Investment committees virtually vanished, and the portfolio manager came to the fore. And the media are quite happy to peddle these investment stars, but many of them proved to be comets, illuminating the fund firmament for but a moment before flaming out. One of the three exceptions which Bogle mentions is Bill Miller. Bill Miller was famous because he beat the S&P 500 for 15 years in succession, and he was touted as an investment legend. But then in 2006, the 15-year run came to an end, and in the financial crisis, he made some bad bets on companies like Countrywide and Bear Stearns. And in fact, in the 5 years after the 15-year winning streak, Miller's fund lost 9% annually and came bottom out of 840 funds in his category. So even fund managers with a long history of success might have just been lucky. So there's a lot to like about Scottish Mortgage, in particular the governance and the low fees. That's certainly something to be applauded. But given the current environment of rising interest rates, that's going to be fairly toxic for Scottish Mortgage, given that it's very much targeted for growth. I hope you found that video useful. If you want to continue seeing these videos, then consider supporting us on Patreon. We rely on your support. For $5 a month or more, you can join our live Q&A session. And if you pay us $10 a month or more, like Kishore Bhagwat, Ian Stenton or Robert Bradbury, you get extra benefits. So as always, thank you for listening.